When we look at the financial markets, we see prices moving up and down. These movements can seem random at first glance. To make sense of this, traders use charts. A trading chart is a visual map of price over a specific period. It shows us the history of what has happened. By studying these charts, we can start to see patterns. These patterns are not random noise. They are the footprints left by buyers and sellers. Understanding these footprints is the first step toward making informed trading decisions. It is like learning to read a new language, the language of the market, where every line and shape has a meaning. The concept of structure is fundamental to reading these charts. Market structure refers to the way the market organizes itself. It is the framework of highs and lows that price creates as it moves. Imagine a staircase. When the price is going up, it makes higher highs and higher lows, like climbing up the stairs. When the price is going down, it makes lower highs and lower lows, like walking down the stairs. This sequence of peaks and troughs forms the market structure. Recognizing this structure is very important. It tells us the current trend or direction of the market, helping us decide whether it is a good time to buy or sell. This structure is not just a random collection of price points, it is a reflection of market psychology. A series of higher highs shows that buyers are in control, feeling optimistic and pushing the price up. A series of lower lows indicates that sellers are dominant, feeling pessimistic and driving the price down. By identifying the overall structure, a trader can align their actions with the prevailing market sentiment. They can avoid fighting the trend, which is often a difficult and risky thing to do. The structure provides the context, the bigger picture within which all smaller price movements occur. Therefore, before we can understand any specific trading pattern, we must first learn to see the underlying structure. It is the skeleton upon which the market's body is built. Without this understanding, we are essentially trading blind, reacting to every small flicker of price without a clear plan. Learning to identify the highs and lows and how they relate to each other is a core skill. It transforms a chaotic-looking chart into an organized map of market behavior. This skill is the foundation upon which more advanced techniques like understanding bricks of structure are built. It provides the necessary context for all further analysis. Now that we understand market structure, let's focus on a smaller component. We can call this component a brick. A brick in this context is a single, clear, and significant price movement in one direction. Think of it as one solid block of buying or selling activity. On a chart, this often appears as a strong, large candlestick or a series of candlesticks moving decisively up or down with very little opposition. It is not a small, hesitant move. It is a powerful push that clearly shows who is in control of the market at that moment. Either the buyers, a bullish brick, or the sellers, a bearish brick. A brick represents a moment of clarity in the market. During this period, there is little doubt about the direction of price. For example, a bullish brick would be a long green or white candle that closes much higher than it opened. This shows intense buying pressure. Conversely, a bearish brick would be a long red or black candle that closes much lower than its opening price, signaling strong selling pressure. These bricks are important because they stand out on the chart. They are not the small, choppy candles you see when the market is uncertain. They are statements of intent from a powerful group of market participants. The key characteristic of a brick is its decisiveness. It covers a significant price range quickly. This impulsive move often breaks through previous areas of congestion or minor support and resistance levels. It is the opposite of a corrective or sideways movement, where price meanders without a clear direction. A brick is an impulse. It is the action part of the market story. When you see a brick form, it is the market making a strong statement. It tells you that a significant amount of money and conviction has just entered the market, pushing price in a specific direction with force. Identifying these bricks is a crucial skill. You are looking for candles or price bars that are noticeably larger than the surrounding ones. They should have long bodies and often short wicks, indicating that the price closed near its high for a bullish brick or low for a bearish brick. This shows that the controlling side maintained its power throughout the entire session. By learning to spot these individual bricks, you are learning to identify moments of significant market force. These bricks are the fundamental building blocks that come together to create the larger market structure we discussed earlier. A single brick is a powerful signal, but its true importance is revealed when we see how it fits into the larger market structure. Bricks are the building blocks that create the highs and lows of a trend. Think of it like building a wall. One brick is just a brick, but when you stack them correctly, you create a strong and stable wall. In trading, an upward trend is built by a series of bullish bricks pushing the price to new highs, followed by smaller, weaker corrective moves, and then another bullish brick. The bullish bricks are the strong, impulsive moves that define the upward structure. Let's consider a simple example of an uptrend. The market might be moving sideways for a while, showing indecision. Suddenly, a large bullish brick appears, breaking out of this range. This is the first sign of strength. After this strong push-up, the price might pull back slightly with smaller, weaker bearish candles. This pullback is the corrective phase. Then, another strong bullish brick forms, pushing the price even higher than the last peak. This sequence, a strong brick, a weak pullback, and another strong brick, is how a healthy trend is constructed. The bricks are the engine of the trend. This concept helps us differentiate between strong, trend-defining moves and weak, temporary corrections. The bricks are the impulsive waves, and the periods in between are the corrective waves. In a strong uptrend, the bullish bricks will be much larger and more powerful than the bearish candles seen during pullbacks. This visual difference tells us that buyers are firmly in control. They are making strong, decisive moves, while sellers are only able to cause minor, temporary dips. Recognizing this pattern gives a trader confidence in the direction of the trend and its underlying strength. Similarly, in a downtrend, the structure is built with powerful bearish bricks. You will see a large, decisive red candle push the price down, breaking previous support. This is followed by a weak rally with small green candles, which fails to reach the previous high. Then, another powerful bearish brick appears, driving the price to a new low. The combination of these powerful downward bricks and weak upward corrections confirms the bearish structure. By observing how these bricks stack up, we are no longer just looking at a series of random candles. We are reading a story of power, control, and direction in the market. Understanding the concept of bricks of structure provides a significant edge for a trader. It simplifies the process of chart analysis. Instead of getting lost in every minor price fluctuation, a trader can focus on identifying these key, powerful moves. This clarity helps in making better decisions. When you spot a strong bullish brick breaking a key resistance level, it provides a clear signal that the market sentiment has shifted in favor of the buyers. This can be a signal to look for buying opportunities, perhaps on the next minor pullback. It gives you a reason to act. This knowledge is especially useful for identifying entry and exit points. For example, a common strategy is to wait for a brick of structure to confirm a breakout. If a market is in a sideways range, a trader might wait for a decisive bullish brick to close above the range's resistance before entering a long position. This brick acts as confirmation that the breakout is real and has force behind it, reducing the chance of a false breakout. It helps you avoid jumping into a move too early before the market has shown its true intention. Furthermore, understanding bricks of structure helps with risk management. The low of a bullish brick that starts a new upward move often acts as a strong support level. A trader who buys after this brick appears can place their stop-loss order just below this low. If the price were to fall back below that point, it would negate the strong buying signal of the brick, indicating that the analysis was wrong. This provides a logical place to limit potential losses, which is a critical component of any successful trading plan. It helps define your risk clearly. In conclusion, the brick of structure is a simple yet powerful concept that helps traders interpret price action. It encourages you to focus on the most significant moves, the moments of clarity and force, and to see how they build the market's overall trend. By learning to identify these bricks, you can better understand who is in control of the market, confirm breakouts, find logical entry points, and define your risk. It is a practical tool that strips away market noise and reveals the underlying story of supply and demand. Mastering this concept can bring more structure and discipline to your trading approach.